So today's session is about understanding how do we navigate in the volatile markets. And financial markets will always be unpredictable. It will always have that sentiment, which is very hard to predict, which is very unpredictable. And at this point of time, every trader, every investor is always trying to manage your risk well. So I always say during the sessions that your goal, of course, is to make profit from your investments, but then you should always be aiming for reducing your risk or try to minimize your loss. I would rather say not reduce your risk, because risk is something which is a very it's a personal tolerant level, that how much sometimes investors like to take more risk, sometimes they like to take less risk. But either way, your aim should be to minimize the loss. And to minimize the loss, there can be different strategies undertaken. And risk management in itself comprises of taking strategies like diversification, pair trades, and then stop loss is something which also we are going to discuss today. And that is something which is one of the most important things, because um, where the financial markets run on sentiments. And always remember this, that any event which is about to happen, the possibility of occurring that event moves the market more than the actual occurrence of the event. So if there is a possibility, or if there is an expectation that um, inflation numbers will go down, so during that particular time, the market will move a lot. Then, when the actual inflation number comes down, or see this way, if the probability of um, Donald Trump becoming the president increases, then the markets will move on that probability more than the time when Donald Trump actually becomes the president. So, like that, investors and the markets, they run on sentiments, and that's why it becomes really difficult, because sentiments and emotions cannot be predicted. Anything can happen. Like if I tell you till yesterday or day before, gold prices seem to be on a lower side. But today, the inflation data came, and as per the Bureau of Labor, the inflation in the United States now has come down to 3%, which is a good thing for US as an economy, because they have been trying to bring inflation down by increasing interest rates. And inflation is coming down, which means that there's a possibility that in the future, central bank may not increase the rates in the same aggressive manner they have been doing, which means dollar might get weaker, and in return gold prices, they have pushed higher. So today lowest gold has seen, so I'm going to share the live screen also with you. While we are in the live session, I'll also keep showing you that how the markets move. Let me just share my platform screen with you, so I hope everybody can see this platform. And I'm just going to put gold chart over here. If you see, the current price is $1,955, and I want to show you this. Look at how last few days have been for gold. See, you see this big movement today. Look at this. Look at this particular bar right here. If you see, today's lowest is 1933 and highest is 1958. And this has happened specifically, this movement has happened specifically in a span of 10 to 15 minutes. If I go much lower and show you, look at this. This is this right here at 4:30 when the news came, right here. See, look at this bar. And afterwards, see how gold has gone. And this has all happened after the inflation news. And see, before this, how gold was moving. Look at this, right? This is how gold has been moving so far. See this. This has been more or less. a very small range and spike. But see what happened after the inflation data. So it's really important, actually, to make sure that we are updated with the data. It's also very important for us to understand that how important every news is. So while we are talking about risk management, we have to understand that the prime form of risk management is trying to reduce your loss. And reducing your loss means that if you have placed a trade in a platform, you have to decide at what price you should get out of that trade. If the markets are going in your favor, then you will book a profit and you'll be happy. But if they're not going in your favor, then you book a loss and get out of it. And the process by which you get out of it is called stop loss. So stop loss is a one form of risk management, and it's a automated order. So while you have placed a trade, and I'm going to show you a live trade. I'll do a live trade and then put a stop loss also on that. So while you do a trade, you cannot be glued to your screen 24 hours, right? You have other work to do. And because markets are really volatile and they fluctuate a lot, I just showed you an example. You cannot keep your trade open as well. When I say you can't keep your trade open, that actually means that you cannot just start a trade and leave it without putting a risk barrier to it. It's very unsafe, and a lot of investors do it, and they make heavy losses. So whenever you see that why a lot of investors and a lot of traders they lose money in day-to-day trading, a primary reason because is not putting a stop loss. If you don't put a risk barrier to these markets, you will lose your entire capital. So please be very careful that while you are trading, always and always keep a stop loss. Otherwise, the chances of losing your capital is very high. It's a very aggressive and very riskier market you are looking into. So let me show you by giving you an example. So right here, I'm sure everybody, let me just switch it to the screen. Yeah. So I hope you can see the screen right now. And I'm going to take an example um, on one particular asset class, let's say gold, right? Now the current price of gold, as you can see, so anybody who has, if you have traded in gold before, write a yes or okay. If you have not, write no. That way I'll understand if you have any other instrument of interest, I can do that as well. You have traded in gold before, or any instrument you feel that you want to look into. You want me to write any other instrument or take a trade in any other instrument. All right, so I see a mixed reaction. Some of you have traded, some of you have not. Okay. So what we'll do is we'll take example of a few stocks as well, and then we'll take example of gold as well. So let's say, give me a name of any company, any. For now, let's keep it to U.S. stocks. So any U.S. stock you feel like, any U.S. stock. Come on, guys, let's try to make it more and more interactive. I know here you just have to hear my voice, but then if you have any other options, you can always use your chat, ask me more and more questions, and let's try to make it more and more interactive. So give me name of any US stock, and we can try. Okay, so S&P, Tesla, Triple Q, Apple, perfect. Okay, so we'll do some examples. Would you be able to talk about Apple stock further? Why not? Let's do Apple stock as well. So I'll open few stocks like Tesla right here. Okay, and I'm going to start Apple stock as well. You can see this is Apple, Tesla, and then this is gold right here, right? So now we are looking at three different stocks, and as you can see, again, all of these stocks have always been into the news. At this point of time, I'm sure everybody understands these companies. Tesla is a EV manufacturer. Apple is one of the biggest companies. If you have an iPhone or a MacBook or an AirPod at this moment, Apple is behind it. So Apple has again recently, if you see, there was a recent launch, and Apple came up with a reality mixed, augmented reality mixed headset called Vision Pro, which is priced around 15,000 dirhams or $3,000, around 15 to 16,000 dirhams. And before it was launched, the stock price continued to move higher, but after the investors saw the price of that headset, we saw price coming down for the stock. But then one thing which you need to understand about Apple, it has always been one of the most favorites in the tech street. And that is the reason that why Apple still continues to be investors' favorite. They are recently coming up with health features. They want to include health features in the airport, and they are going to change the display sizes of the Mac as well. So Apple is always in the news, and if we see currently the chart, you will see that Apple is very close to its all-time high. If you look at this right here, see this, very close to all-time high right here. So if I were to take a intraday trade in Apple, right, at this point of time, let's see, I would want to see a very small duration chart, let's say for 30 minutes. And as we see, the current price right now is $189. It's right here. But if I have to place my trade, I would wait till the price drops to at least this level. Just everybody with me, if you can see this. Either here, which is the first support level, or most importantly, a good price for Apple to buy on a short-term trade right here. Just going to make one neat support line right here. This, see, look at this. And I'm making this on a very short-term chart, guys. So right now it's 189. If it comes to 184, it could be a decent buy. So what you can do in your portfolios, I mean, again, please do not take these trades as the current recommendations. This is, I'm just showing you how you can use a chart. Any trade or any trade which you want to place, please talk to your risk consultants, please talk to your risk experts, and only then go ahead with these kind of trades. This is, I'm just showing it to you. I'm using a demo account right now. So if you're also using a demo account, you can always try these features. So uh, one way to also manage your risk is by entering on the right entry and exit points. So right entry and exits are really important, guys. A lot of investors and traders, they make a mistake that they see the current market price and they buy and sell at the current market price because they are always scared that they might lose the opportunity. So losing the opportunity is better than entering at the wrong time. So if you see right now, you see this gap right here. Look at these small gaps which has been created, right? A lot of times these gaps are created when a stock rises or falls during the pre-market hours. Before the market opens, a news comes in which pushes the stock really high when the market opens. So these gaps get created. And a lot of times when gaps are created, the price goes up and then eventually comes back and fills that gap. So if you see the gap which was created here, price went up and came down. Again, you see the gap which was created here. We saw the prices coming down afterwards. And now the gap is created here and the price starts coming down. So I think a good entry point for Apple could be around 184, let's say, in a very short term trade. And also, we should not forget that if you enter buy at 184, you also need to have a proper risk management on a very short term chart, right? So over here, I would also keep a stop loss. So if you see, this is a very important support line at 182. This gets broken, price is at 180. Now it depends on how much quantity you have purchased, what is your risk tolerance, because a stop loss below 180 makes more sense over here, somewhere around 179 or 178, which is away from its support levels. Because after 180, the support is directly at 177. So you can keep a stop loss below 180 if you buy at 184. And so there are few features that if I want to put a stop loss, where should I put a stop loss? And This is where we start to understand that when we are even putting a stop loss, what are the important elements? First and foremost, determining your risk tolerance. This is one of the most important thing, guys, because a lot of us, we want to make profit, but we don't want to define that how much money we are ready to lose. Risk tolerance is something which is really, really important. You have to define what is your goal, what's your investment goal. If you have bought Apple stocks today, what is the profit target you have in mind? And defining your risk tolerance, it not only is based on your investment goals, but what is your financial situation like? How much, what is your emotional capacity to handle the potential loss? If you lose in this stock, let's say $500, are you emotionally uh, capable of handling that loss of $500? Because this is going to influence the amount you are willing to risk for every trade. In my case, if I am willing to lose $500 today on this particular trade, I will be more than happy to buy 100 shares at 184 and keep a stop loss $4 or $5 down and risk $500 for it, right? So first and foremost, you have to determine your risk tolerance, and that's something which is really important. There's a question, quick question about Apple. Some people buy stocks before an announcement, but you said that it had dropped after the latest announcement. But usually after release, especially a new item that's revolutionary, the stock increases in a significant amount. Would it still be wise to do a stop loss? So every slide which I'm going to share, it will have this feature covered also. But since this question has been asked, so after every new launch of the product, if you go back in the history of Apple stock, I think after iPhone 6 or after iPods and iPhone 6 or 7, every single time Apple has launched a new product, initially the stock price has actually dropped. And that is also, if you see last time when 5G iPhones with 5G were launched, Apple stock price went down, but Verizon, which is the provider of 5G technology, the stock went up for Verizon. So this is in case of Apple, this has potentially been seen that after the launch of the new product. Now, Vision Pro is, it could be a very revolutionary product because everybody said that how revolutionary a headset by Apple is. It's going to change the way people play games. It's going to change the way people communicate, the way people work, and that's good. But at that particular price and at this moment, it did not feel like a good revenue contributing source. So that was the reason the stock initially went down. But as we have seen that after it went down, the stock slowly and gradually continued to go higher. And that was the result of the other revenue contributing activities which Apple is doing. Now, whether it is with airports or it is with changing the size of the Macs, all of these news they come into the picture. Uh, Usually, after release, especially new item stock increase, would it still be wise to do a stop loss? Now, coming to a point whether you should put a stop loss or not. So, I have one specific. We were talking about this slide. I'll just jump on one point. I think this was about. Yeah. So I think I think we should see analyzing market conditions is the next point itself. So analyzing market conditions about a company is important, about a stock or a commodity is important. So what happens is, as you said, if a product is being launched during that time, and if you have seen the Apple event, the time when the products are being launched, and I'm talking about Apple specific since the question is directed to it, during that entire session in WDC when this is going on, you will see the stock is very volatile. It's moving a lot. So during that event is going on, it's not wise to put a stop loss. Actually, it's not wise to do a trade while that sort of an event is going on. Because what happens is, the same thing happens when a central bank rate announcement is about to happen. It does not matter what is expected in the market. The moment you do the rate announcement, And the moment you place a trade after looking at the rate announcement, the market will still continue to be volatile because after the rate is announced, a press conference begins after 30 minutes of that announcement. And during the press conference, there are a lot of things which the reporters will ask, and the central bank chairperson would reply to it. And on those basis, market would move, and that would be really volatile. So the important part is during any event, any important press conference, or a very so during the U.S. elections, for example, a lot of investors they trade during the U.S. elections, and while the exit polls are coming out before the results even, the exit polls you should see the volatility. And now putting a stop loss during that volatility is crazy. It might hit your stop loss and bounce back, right? So altogether, it is always said that you should place a trade after the event has happened, after the dust is clear, and then you should put a stop loss. Anybody who takes a trade during the event is basically speculating, right? So the risk is that if you keep your trade open and if the market plummets, you lose much bigger amount than you anticipated. And if you put a stop loss, then it might just hit your stop loss and comes up because you have seen the volatility. So the important part is never trade during the event, always trade after the event. So analyzing market conditions is basically you analyze the fundamental conditions of when you are placing the trade. Because during that event, the market volatility, the strength of the price will come into the picture. So putting your stop loss is really, really important while you are looking at a specific event. I don't really normally I do not trade during the event. So, for example, today, if you see gold prices moved from 1930 to 1950, right? Anybody who had done a short sell trade and expected gold price to come down, had he put a $10 up stop loss, it would have got hit. Why? Because the news and the event, the news created that sort of volatility. But you see, after the news was declared and gold jumped to 1950, it came down to 1945 and now it's again to 1944, 1945. It's slightly more stable than it was during the news. So never trade during a specific event, because if you're trading during a specific event, you are expecting that prices will jump and you will book a bigger profit, right? But that is just speculation. If you were to do this in a more disciplined way, you wait for the event to happen, and after the event, you will get clarity where the stock actually is at that particular point. To answer your question, it will not be wise to put a stop loss during that event. I mean, it is always advised to put a stop loss, but because you're asking a very event specific question, that's why I'm saying any stop loss you put, the chances are it will hit your stop loss. Either it will go down or it will bounce back. And I feel that it is always good that if it hits your stop loss and goes down, you are safe, rather than regretting that, oh, I should have put a stop loss, right? The regrets should not be there. So an ideal scenario will always be that you should always put a stop loss in your trades. For the events, please avoid to do any trades during the events unless you are doing a very long term trade. If you have that idea that I'm going to buy Apple and keep it for 2 3 years, so you're going buy and hold, you're going on a long term perspective. Then you can buy and not put a stop loss, but that should be with the condition that you are not leveraging too much in a portfolio. What do you mean by leverage? Leverage means, to give you an example, let's say if I want to buy Apple here and I want to buy Apple worth $500,000, okay, or let's say 2,000 shares. Please enter okay, minimum quantity 1,000 shares. 1,000. Let's 1 second. Say 900 shares, which is equal to 170,000. Now, how margin trading works, how leverage trading works is to buy this 170,000 worth of shares, I will have to give only $25,000 from my own account, and I can still have an exposure of 170. So this is called leverage trading. Why and how? Leverage trading basically means that you use borrowed money from your broker to magnify your position so that your profits can be magnified. But what happens is your losses can also be magnified, right? How you buy a piece of real estate? When you buy, if you have to buy $1 million worth real estate, you will give a down payment from your end and then mortgage the rest of the money, right? So the idea over here is the same, that whatever value of stocks you want to buy, you just block a percentage from your equity, which is like a down payment, and rest is provided to you by the broker. So what happens is, in this case, the margins can be really insane. You want to buy something worth half a million, all you have to do is just give $50,000 and you can have a position worth half a million. And if you don't put a stop loss to that position, you might end up losing a bigger amount, right? Because you have leveraged it a lot. So if you don't want to put a stop loss, please do not leverage at all and do not trade during an event. That should be the right idea. Correct. Moving on to the next part, set very clear objectives. What we discussed, that your profit targets have to be realistic also. And there is a way that you can actually make your profit targets realistic. How? By understanding the range of how much an instrument actually moves. And to tell you this, I'll give you an example of gold right here. Or so I'll take one by one. So look at gold. Today's low in gold, if you can see, is 1933 and highest is 1958. So I can see that there is easily more than $20 of movement happening. I go to the chart, okay, go to technical, and click on ATR. ATR means there is something called average true range, right? When I click on average true range, right here, save. So if you see average true range for gold right here, let me increase the period actually. Oh, this is a 10-minute chart, sorry. Let's took it on a daily chart, right? Looking at daily chart. Now, if you see a daily chart, the average range around is 17 to $20. If you see right here, somewhere around 25, 17 to $20. So you know that realistically, gold is very much capable of moving $20 in a day. Now, if gold is capable of moving $20 in a day, so if you buy, and I'm going to take a trade here, and again, not looking at the direction, just taking a random trade over here. Let's say I buy 100 ounce of gold, right? I buy 100 ounce of gold, confirm, place the order, and I just bought it. We're not looking at the direction, we're not looking at the view, we're just doing a trade to show you how we could put a stop loss over here. So I look at my position currently. See. So it shows that I bought 100 ounce of gold at 1955. Now, the point is, my realistic target on this is that maximum, because gold moves $20 in a day and I'm doing a day trade, my stop loss either should be, so my profit target should be within that $20 because the average range is around $20, right? So I can say that I can lose $2,000 or make $2,000. Now, in this case, if I want to put a stop loss right here, just 1 second. See. So one way I can put a stop loss is edit this, put a stop loss, and I have bought at 1955. So I know it moves within $20. So the range which is there, I can put my stop loss slightly below that range, right? So if it I have bought at 1955 and 1935, today's low is 1933, I can put my stop loss somewhere around 1929, right? Because the lowest is 1933, or I can put my stop loss at say 1931, for example, which shows me my loss of 2470, right? Because I bought 100 ounces. Again, quantity depends on your own understanding. So my take profit should be at least $2,500, right? But when I see my take profit, how much it shows? 1980, right? At least 1980, because I have put a stop loss Below this level, below this $20 range, I have put my take profit accordingly, 20 to $25, $20 to $25. If you reduce your quantity, you can still make your stop loss wider, but please make sure that your risk and reward ratio is at least equal. So a lot of investors, they make this mistake that a lot of times you take a trade, you put a stop loss, but the moment you see a small profit of $50, you just close your trade, while the stop loss which you have put is of $500. So you are ready to risk $500, but the moment you would see $50, you would book the profit. That's not the right risk reward. What you should do. Question again. Same way you can put a stop loss after buying. You can also remove it. Yeah, yeah. You can always remove your stop loss. You can always remove it. You can always change it. So, like for example, if I put a stop loss right here, I click on the same edit, click on close or remove stop loss, remove take profit, and you can do this. So that's easy. But the idea is that, and so this is one way. You look at the range and you decide your stop loss. Another way is you look at the technical indicators like stop loss, resistance and support. So if I have taken this trade, let's say today the buying trade, and I'm looking at the chart. So if you see this, this is where I have taken a trade right here. Okay. Now, if I've taken my buy trade over here, somewhere around, yeah, 1 second. Yeah, this is my trade 1954 right here. Now, if I have taken my trade over here, if you see, this carries a strong support right here. Let me draw this for you. What is a support line? A support line is like a price where every time that price comes, the price, so every time gold will touch that particular level, price level, it will bounce back like a trampoline. Why it's called a support price is that at that particular price, whenever gold touches that price, it bounces back like a trampoline. Look at this. So what do I put it right here? So check this here, and then if you see, so if you see this, look how neat this is. Every time this price hits this trampoline level, it bounces back here, here, here. And see how when this trampoline is broken, it just goes all down and then again struggles back to get back to this trampoline. And once again it enters, you see the price continues to be above this. Again, it came down here and bounced back, came down, bounced back. So, and this level is which one? This is 1902 because I'm looking it on a long-term chart. Okay. So you can see that how 1901 is a very strong support level, right? So one of my stop loss should be below 1901, but because my quantity is 100 ounce, I cannot wait for gold to go down $50. It's $50,000 loss, right? So I reduce the duration of my chart from 1 day to say 4 hours, for example, right? Now in 4 hours, what I see is a strong support line somewhere around, see these levels. Look at this. We draw one support line right here. Sorry. See this right here. Somewhere around these levels, right? See right here. Look at this support level. See, the moment this trampoline gets broken, you see all of this area, right? Now this is on a short-term chart, it's on a 4 hours chart. So, and what is this level? This is 1938. So ideally, my stop loss should be somewhere around 1936 or 1935, where I kept it earlier, right? Because if it touches 1938, it might just touch my stop loss, hits it, and bounces back, right? So I should not keep my stop loss at exactly at the support level, right? So earlier, if you don't know how to read the support level, you could just keep your stop loss and it will touch that level and bounce back. And then you'll be like, I don't want to keep a stop loss. because it touches my level and bounces back, right? So to avoid doing this, you always have to understand that the stop loss should be kept below a support level in case you have a buying trade. If you have a short selling trade, then your stop loss should be at a resistance. What does it mean? Let's say instead of buying, you have short sell gold, right? Let's say at this price, 1955. At that point, what should be your what should be your stop loss level? So this is your resistance right here, or this is your resistance right here. So it could, if you pick this because this is more prominent, your stop loss should be above this level, somewhat here actually, to be fair, because these are the resistance level, somewhere around here, around 1987, because 1973 is the price it touches and comes down. So if you have short sell it here and you keep a stop loss at 73, it might touch 73, book your loss and comes down, right? So it should be above, it should be kept higher from the resistance point. And that's how normally you place stop loss in every instrument. Never keep a stop loss at exact support and resistance levels. For that, you need to understand that how to read support and resistance. It's a very, very easy way. Not everyone needs to understand entire technical analysis to identify the support and resistance. Okay, this is the most easiest thing you can do. Just look at the chart and see from where you see the prices bouncing back. If you see this chart, you can see the lines which I have drawn. It kind of defines the range from where prices touches and bounces back and hits a ceiling, and it's not able to cross that ceiling, right? And the moment it crosses that ceiling, the trend completely changes. So this, and again, over here we have a lot of consultants already, whom when you sit with and when they're reviewing at your account, they can always talk to you and talk about good support and resistance, good entry and exit points. So you can always discuss that with the consultants as well while you are looking at it on your own, right? So we set clear objectives. We'll utilize technical indicators, as I told you, that you utilize the average true range. See what is the range, how much an instrument moves. So this is I'm telling you today. If you want, you can write it down somewhere. Gold easily moves $20 in a day. So when you are taking a trade, please manage your quantities accordingly. That you should be ready for a $15 to $20 movement at least. Crude oil, $1.5 or $2 movement easily every day. Okay, a currency pair like euro, yen, easily it can move 50 to 60 pips. What is 50 to 60 pips? Like if euro is 1.1050 today, it can easily move to 1.1100 or 1.1000, 50 pips up and down. So you can manage your quantities accordingly. Similarly, if we see US 30, or if we see S&P 500, for example. So S&P 500, to show you on, sorry, to show you on the platform, just look at S&P 500. Because guys, it's really important that you should know that how much an instrument is capable of moving before you decide your risk and return, right? See, S&P 500, the price is 4472, right? Now, easily 0.5 to 1% movement can happen in an index. 0.5% at least. 0.5% means at least 25 to $30 movement in S&P can happen. So today, if you see, the lowest is 4430, highest is 4488. Today it has moved very easily around 40 to 50 points. But the idea is that day on day basis, it depending on the news, depending on if there is something extraordinary, like July is the month of earnings, right? So we have to discount, we also have to consider, not discount, sorry, we have to consider that July is the month of earnings. So every company is going to come up with their earnings. Apple, Amazon. In fact, next week onwards, you will see JP Morgan, Citibank, Wells Fargo, all of these companies, the financial companies. And then by the end of this month, you will see a lot of tech companies. They will come up with their earnings result. And if the earnings are collectively good and positive, better than the analyst estimates, you see stocks and indices both going up really, really high. It's going to be a very good month for trading into stocks, even intraday if you want. So always understand how much on a range wise a basic instrument moves. So if you ask the consultants over here, they will also tell you that see gold has a history of moving at least $15 to $20 a day. So instead of buying 100 ounces, you can start with 20 ounces, right? And aim for a $200 profit or loss. So you can widen your stop loss beyond that range and have a better chance of reducing your loss or minimizing it. So that way, we should always try to do it. Another thing which we should always keep in mind, volatility. So if an instrument moves too much, if it is too volatile, like if you see Italian index moves a lot, uh, while at the same time a stock like Coca-Cola, it doesn't move that much. To give you the live understanding, look at this. So I'll show you Nvidia. Would look at the price of the stock, $434. Okay. Look at the highest, 439. Look at the lowest, 427. Nvidia today has moved from 427 to 439, $12 movement. At the same time, a stock like McDonald's. Look, see, both the companies are three digits. Look at the price of McDonald's. It has gone lowest 294, highest is 296. Okay. But Nvidia, lowest is 427, highest is 439. While McDonald has moved hardly $2 range, Nvidia has moved in $12. Reason? Because Nvidia is a tech company. Tech companies they move a lot. McDonald's is a food and beverages company, which is much less volatile. So every stock has a volatility. Now the stock which is too volatile, and this is to be again, guys, very important because volatility plays a very crucial role in setting stop loss levels. If a stock is more volatile, then those assets may require a wider stop loss level because otherwise your exit will be very premature because price will fluctuate. But the ones which are less volatile, you require a tighter stop loss to protect against decline. See, for McDonald's, if it starts falling down more than $2, which means it might go down even further, right? But in case of Nvidia, $3-4 decline, you can't put a stop loss $3-4 down because it might just hit and bounce back because it moves only $10-12 a day. So you have to consider the volatility of the instrument also. A lot of investors I have seen they don't put stop loss because they're like, oh, it hit my stop loss and bounce back. But have you even considered that was that a natural movement of that commodity or it just happened with you? Because it happens a lot of times, right? And that's why we have to be very, very careful. We should always be very considerate. Try to understand the movement, try to understand the volatility factor because not all instruments move in the same manner. Gold moves $20 a day, oil moves $1.5 a day. Depending on how much quantity you have purchased, if you have purchased 500 ounces of gold and you have just $200,000 in the account, that means that you cannot keep a very wider stop loss because every $1 drop, you are losing $500. You have leveraged it too much. But at the same time, if you have $200,000 in your account and you just have bought 20 ounces of gold, then you can still put a wider stop loss. So it depends on the volatility. It depends upon your quantity, on your risk appetite, that how you can place your stop loss. Use your technical indicators, guys. Use the technical indicators to put a stop loss. See, let me show you another technical indicator. Uh, like Nvidia, for example. I'm just opening a random chart for Nvidia and look at this. So, for example, if instead of daily chart, I were to look at 4 hours right here. Now, because this is a gap, but I'll still make a try to understand a trend for this. Okay, I hope this can be. See, look at this. Now, as per this trend line, it still continues to look on the higher side, right? Barring this, if you see here, here, here. So if you are buying at 434 or 433, then your stop loss should not be at 420, because 420 is where the price might drop and bounce back, because the trend is still upside. Everybody, if you can look at this, right? Because I still see everybody is here, so that's great. I thought that could be very boring for you, but then I see a lot of people are actually asking questions, enjoying it. So look at this. If you buy here, and when you see on the downside, if you put your stop loss here at 421, it might just touch your stop loss and bounce back, because this is how the trend has been. You should wait till this. So your stop loss should be below this trend line, because if the trend line gets broken, right? Look, somewhere around 416, because then it might start a trend on the downside. So you might as well just exit from your position. That is the idea, how you use resistance and support and then trend lines to identify a stop loss, right? Please look at the trend and only then take a trade. So that is really important when you're looking at an upside trend or the downside trend, right? Just to give you a small example of a downside trend, uh, uh, just one second. Right here. See, just to give you an idea, look at this. This is a downtrend which, when gets broken, goes upside. Okay. So when you are looking at this and you have, say, for example, you have short sell it here and it's going down and it's fine. But the moment this trend line will get broken, right here, or let's say you are on the buying side of this, where you have bought it here, your stop loss could be here, but your stop loss ideally should be below the trend line. Actually, let me make a better line for you. Let me clear all this. So, yeah. So let's move on to a different chart also. So this was NVIDIA. Let's show you Apple, for example. Same trend line, we'll try to find an Apple if it is possible. I'm looking at a very 30 minutes chart which has too many gaps. Let's say 4 hours if I can. Okay, now if you see in 4 hours, I'll just form a channel actually. Look at this. To show you, look at this, right? Look at this. Now, what happened? If you bought it anywhere around 194, and if you had kept your stop loss at 190 or at these levels, it will hit and bounce back, right? But what has happened? Now, the moment if you keep your stop loss below 190 here, now see, the moment it has broken this trend, now it's consolidating, right? Now it's still struggling to go back. Look at this candle that started forming on the downside. Might go even to 184, you never know. But the point is, your exit is much better if you keep your stop loss below this, right? Everybody can look at this particular line. So this is the idea, that how you can actually determine your stop loss using technicals, and it will, your consultants will help you. And this is not something, please guys remember this, you don't have to do a certification, you don't have to do a course to learn these things. You can just see yourself, attend these webinars, or just Google this stuff and you will find it there. It's not any rocket science. Please don't think that this is some rocket science which is going on. These are very easy things. Every trader, investor these days now look at these things, and this is the right way to do it. Okay. Because fear, greed, it always surrounds us. We are humans. It happens with the best of us. I have also made a lot of losses in my personal portfolios, went out of league. But I have understood that every loss, it should teach you something. So every time I would put a stop loss now, I will always make sure that it is either below my support line, or it's not at the tip of that trend line from where it can bounce back. I would always see the range of the instrument and then trade. And I'll not take a random trade ever. I'll always put limit orders. I always put pending orders and enter and exit. Entry and exit should be very, very clear. It should define, it should be very much clarified to everyone, right? We should consider volatility, should use trailing stop loss. This is it's a very good feature. I'm not sure how many of you have actually used a trailing stop loss, but trailing stop loss is something which follows a trail, or which follows the price. How a trailing stop loss works is that, let's say you have purchased. So to give you an example of a trade over here, for example, right here, it's my position. Okay, look at my position right now. So I purchased gold at 1955.75. Okay. Currently, my loss is $68. If I have put a regular stop loss, which is called a time-based stop loss, sorry, which is called a regular stop loss. What is a regular stop loss? A regular stop loss will be that I edit this trade and put a stop loss, say 100, $500, $5 down, just randomly like this, which shows 1960. All right, here, 1960. I have put a stop loss, modified this, and now it shows right here. Oh, sorry, what happened? Sorry, I think I closed my trade. Sorry. Just 1 second. What actually happened? Gold. Okay, sorry. Let's say I bought 100 ounces of gold and put a stop loss at, yeah, sorry. I bought it at 1956. So let's say 1950, right? And no take profit, just place my order, right? So I have purchased gold at 1956, kept a stop loss at 1950. Now, in this case, what happens? If the price comes to 1950, it will get hit, right? Imagine I have not put any take profit here. I bought it 1956. I go to sleep. Gold goes up to 1975 also. But because I have not put a take profit, and I cannot, I'm sleeping right now, so I cannot see what is happening to my portfolio. It went to 1976, came down back to 1955, and by the time I woke up, it went down to 1950 and hit my stop loss. Now, what happened here? To me trying to maximize my profit and not putting any take profit levels, I just put a stop loss, went to sleep, and it went up to 1975. I was not aware. It came down and hit my stop loss. So what would have been a very profitable situation now had a loss. What a trailing stop loss does is that if I put a trailing stop loss, I'll show you a different platform where I can show you a trailing stop loss as well. Just 1 second. Before we end the session, just right here, wait with me. Yeah. See, so just buy gold over here. Same thing, 100 ounces, stop loss, 1950, for example, a regular stop loss, as you can see, place the order. So now if you see my positions, I have put a regular stop loss right here. It shows 1950. Now the thing is, as I said, that I have not put any take profit here. So it can go really up and I wouldn't know. It might come down, hit my stop loss. In case of a trailing stop loss, what happens? When I modify this from regular to trailing, see what changes over here. Modify, close. The moment I put a trailing stop loss, now if my price goes up, my trailing stop loss, my stop loss price will also slightly move higher. So if I bought at 1956 and if the price goes to 1966, my stop loss will automatically move to my cost 1956. I hope everybody can understand this. So for example, I bought at 1956. Sorry, if I bought in 1956, I put a stop loss at 1950, a trailing stop loss at 1950. So if my price goes up to 1962, my stop loss will move from 1950 to 1956, which is my cost. If it goes to 1963, my stop loss will move to 1957. So basically, the idea of trailing stop loss is that without you even seeing that where the price, what happens to your profit, the stop loss will follow the increasing price. And if the price starts to come down, then the trailing stop loss doesn't come down. It just follows the price on the higher side. This is really important. Why? Because imagine that you placed a trade at gold in 1956, right? And you have not put any take profit and you have kept just a regular stop loss. So you don't even know if markets go up and you will be able to book profit, right? But in case of a trailing stop loss, if market goes to 1970, your trailing stop loss will move to 1966 or 1967. And after hitting 1970, if it starts coming down, then it will hit that 1967. So you will still end up making a small, not a small, a reasonable amount of profit. And this will happen automatically. So trailing stop loss orders are really, really important, guys, especially in the trades where you have started making profit. What you can do is put a trailing stop loss at the particular cost where you bought, so that even in the event when the market comes down, you end up at least making some profit, right? So this is something which we should always look at it. Again, some psychological factors really play an important role, guys. Please don't train your mind which tells you that let's not put a stop loss. Okay, trailing stop loss, if you implement a trailing stop loss, it will automatically adjust your exit level if the price moves in your favor. Okay. At the same time, if you look at a lot of these psychological factors, be very mindful of these factors because this influences your decision making. You have to stick to a predefined level. Please do not make emotional decisions based on fear or greed. Okay. This is really, really important. Never remove a stop loss just because you feel that no, it will go up. I've spent enough time in the industry to understand that even the best of us can get uh, manipulated by fear or greed and remove our stop losses and then regret it. Next is risk reward ratio, something really important, guys. If you see, every time I put a stop loss of 500, I intend to make a profit of 500 also. So please ensure that your potential reward justifies the risk which you are taking and your stop loss level is aligned with your risk reward balance. A lot of times, client would keep a stop loss at $2,000 worth, but the moment they see $100 profit, they book it. So this should be definitely stopped. This is not the right risk reward ratio. If you are willing to lose $2,000 just to book a $500 or $100 profit, that's not right. So please adjust your risk reward either to 1:1 or 2:1. Risk $100 to make a $200 profit. Your take profit should be at $200. Your stop loss should be at $100. But never go vice versa. Never risk more than your reward. And then sometimes during volatile markets to diversify and manage your risk, please stick to SIPs. See, if you had put $1,000, start putting $1,000 since 1988 in S&P 500. As of May 2022, your total amount invested would have been $500,000, which your value would be around 3.2 because annualized return will be around 10%. Similarly, if you had started putting money into SIPs of S&P 500 since 2012, till 2022, your total amount invested would have been 125, which would have given you an annualized 13% return and your value would have gone to $250,000. Imagine this you just do by putting a dedicated $1,000 every month to an SIP of S&P 500, right? So please stick to your SIPs. This is another way to diversify and manage your risk. SIPs are one of the best things which can happen, and especially during the times when markets go down. That is the best time because every time markets are crashing throughout the year, month on month you get to invest into S&P and buy at a best low. So when markets move up, you will get a very good average price. So please stick to your SIP levels. Another way of managing your risk is looking at the sectors. When the markets are really good and accelerating at a greater pace, you should stick to sectors like financials, industrials, IT sector. And when you see that markets are still positive, but growth is very moderate, try to get exit, try to get out of materials and utilities, try to get out of luxury stocks, right? And when you see that the growth rate has been slowed, please start investing more into FMCG, consumer staple, healthcare, utilities, all those recession-proof products, right? During recession, continue to invest into utility like Diva, for example, or coal and power-based companies. Get away from IT stocks. What happened in the last 1 year exactly, mid 2021 and 2022, the entire year we saw tech stocks falling because the inflation was so high that there were fears of impending recession, so a lot of people started investing into healthcare and consumer staples rather than tech. Now again, since inflation has come down, we see that sector has started going up. So this is sectoral investing is something which is really important, guys. If your idea is to have a very defensive strategy, you see a slowing economy, don't want to take too much risk, don't want to have too much volatility, stick with utilities, healthcare, consumer staple. If you are looking at a growing economy and you feel that economy is going to grow and potentially is going to enhance returns, so you start investing into IT and financials and luxury stocks like that. And then if you're expecting a rising inflation, which was there, so a lot of investors invest into energy because a rising inflation means raw materials and oil, etc., will go up. So real estate, energy, material-based stocks went up last year. We saw a lot of stocks moving higher. So that way you plan your sectors, right? Another question: can we put a trailing stop loss as well as book profit? You can. But see, the point of putting a trailing stop loss is that you have not put a take profit, and trailing stop loss actually maximizes your profit. So nothing bad. You can always put a trailing stop loss, and you can put a take profit also. Definitely. Right. So, with this, we have reached the end of this session. I hope that you know information was fruitful to you. As I said, guys, again, markets run on sentiments, and we can't predict sentiments. So it doesn't matter how much. The only way to be existing in the market, trying to take wise decisions, first of all, be familiar with what's going on around you, and that can happen if you even just read general news, and that's all. Second thing is, try to diversify, guys. Don't try to stick with one instrument, because if you try to stick with one instrument, you are basically putting all your eggs in one basket. Even if you don't have knowledge about others, try to gain some knowledge. Talk to the risk consultants. There are so many companies these days, even ours. We provide you financial consultants, and they will always keep you informed about what's happening with semiconductor industry, what's happening with agricultural industry, what's happening with commodities, what's happening with different indices. Gain that knowledge so you can diversify your risk also. As far as stop losses are concerned, every day trader should put a stop loss without fail. If you're doing an event based trade and you see there is too much volatility, so you take a call, keep lower quantities and keep wider stop loss. But never take excessive leverage, never take higher quantities and put wider stop loss. You are just basically going psychologically wrong over here, right? Rest, you can always talk to your consultants and they will definitely help you out. There's a question here. Will you be available for a one-on-one personal session? Yes, definitely. We always do public webinars, but then if you want to have a one-on-one session personally, you can come to the office. We can set a time and we can discuss more over this. Definitely. Can we get a demo account? Yes, definitely. You can get a demo account. Just talk to your relationship manager who connected you to the webinar, and they can definitely give you a demo account as well. So you can practice. Definitely, it's the right thing to do. Perfect. So thank you so much, guys. Thank you so much for being a part of this session, and I'll meet you next week with a different topic, and hopefully we'll share more and more information next week as well. Please review us on Google, reviews on Century Financial if you have liked this session. Tell us how we can improve. I'm based outside the country. Not a problem. We can have a session on Zoom if you want. I can have a session on Zoom and we can discuss more on this. However, as far as the platform is concerned, you can always take a demo account. We can always provide you a demo account, which you can use using your app or web. You can always use that, and we can do a Zoom session for you if you're based outside the country. So do not worry about that. Perfect. So thank you so much. Please reach us out, review us on Google reviews, and we'll continue to do these sessions free of cost. I'll see you next week with a different topic, and hopefully we'll learn more and more. So until then, please continue to invest, manage your risk well, and reach us out if you have any doubts or any queries. My name is Yogesh, and you have a great night.